Derivatives trading involves substantial risk of loss and is not suitable for all investors. Past performance is not necessarily indicative of future results.
So stressful when the world's on fire. Good God. I can't look at this, guys. Like, my strategy is you buy it and you hope that you got a good spot. Yeah, but we all think you're crazy. You don't fight this. No way. The markets are freaking out and you don't think that anything is wrong? Come back tomorrow and I'll lose it all. Should be fun.
Good morning. Hold on. The music is starting. There we go. So, it is Tuesday. It's Halloween. Overnight, we had Bank of Japan announcement, and market did not quite react the way that we anticipated, or that you would think that it would based off of what was announced. So let's come into the charts and see what happens. So you can see here, we are up overnight, and rates are back to about 4.8. We were at 4.9 yesterday. The Bank of Japan did adjust their yield curve control to allow for interest rates on the 10-year above 1%, but the way that they did it and the language and so forth that they used was not quite what the market was anticipating. So the market is reading this as more dovish than anticipated, and that's why you saw rates move down. Now, I may be possible that as this goes along, that people say, but this does mean higher rates overall anyways. But maybe not. I don't know. Let's see. That might not be the most reliable flow. This is one of those things where it's like we can predict the flows, but like sometimes, unexpected things come through, and it just kind of becomes a crapshoot. So, and we got the Federal Reserve meeting tomorrow too, so that might make our flows really unreliable, right? Coming over into the S&P 500, they are trying to pull out a win here. I mean, we've been on a really awful losing streak, so another winning day could really make the chart look different and more positive. We got oil here languishing below 83, so the overall economic outlook doesn't look very good at the moment. Gold and silver continue to hold that they're amazing gains. In fact, silver taking a pretty good jump yesterday, and copper looking not too bad either. So the metals complex is looking strong. Bitcoin just kind of dancing around all over the place here. Oh, sorry, we just had our news. I'm sorry. U.S. employment costs 1.1% versus an expected 1%. That does not make sense why I'm getting this movement. Anyways, dollar is below 106. Let's come back over here. I missed something. I did not think that we would be moving on U.S. employment costs. Is there another Canadian GDP month over month spot one for 0 versus expected spot 1? Nah, there must be something else. Was there another piece of news in there? That just seems weird to me. Employment costs being 1.1 versus an anticipated 1, is that really that big of a deal? I don't know, man. It's kind of weird. That seems like an outsized move, but or let's just roll with it and see what's going on here. I mean, that was a pretty big sell off of that. That was like 10,000 contracts came through. So yeah, those are the only two that I see, though. I don't see how either of those numbers results in what we're getting here. Hey, the pen is working pretty good today. I wish I knew what it was that causes it. In fact, it's working really, really well today. What's with that? Well, it's still a little funky. Need to practice more. So let's reset some things because there does appear to be a little bit of some volume building here at 14.5. Seeing the dollar move pretty. It's a pullback of the overnight action, but the dollar looking strong there as the rates rose. That was like a 3 basis point move. This is a little weird. That they're paying attention that closely to that particular number, I find incredibly odd. Eric Wallerstein says, for Halloween, I wrote a spooky story about the dangers of holding too much cash in your portfolio. It still looks pretty heavy, man. I hate it when I feel out of the loop, you know? Hate it when I feel out of the loop. So here's an interesting tweet from Santiago Capital being retweeted by Bob Iacino. The U.S. owes over $30 trillion in dollars. The rest of the world owes over $30 trillion in dollars. The U.S. has the ability to print to meet the obligations the rest of the world does not. The U.S. has massive external demand for its currency. The rest of the world does not. That is an interesting take. I think he's right. It seems to me that the dollar can remain relatively strong here. I mean, everybody thought that the dollar was just going to get pummeled, you know, and it hasn't. And still looks heavy. I mean, I think that they are in a little bit of a liquidity hole. It's looking like it's taking more volume in order for them to continue to push. But they continue to push. So we're coming up on maybe 15K contracts traded. About 15K net contracts traded to the downside. Okay, so let's read here Mohammed El Arian's reaction to the Bank of Japan. So the headline was, the Bank of Japan said it will take a more flexible approach to controlling yields on the 10-year government debt, saying the 1% level was now a reference point. According to its statement Tuesday, that marks a shift from a previous pledge of daily bond purchases at 1%, stance that effectively drew a clear line in the sand there. Mohammed A. Al-Arian says, further to my column in opinion and per Bloomberg below, the Bank of Japan made some tweaks to its yield curve control policy overnight. The immediate reaction of the markets will be interpreted by some as a signal of the need to do more as both JGB yields went up and the yen depreciated. There's they push, still pushing. There has got to be something else in all that news that just pumped through. Silver tends to perform less well than gold at times of increased risk aversion. Probably true because silver is more of a risky asset, but as of late, it's been performing pretty darned good. France, UK, and the Netherlands draw up plans to ship aid to Gaza. You know, now that Israel is moving into the Gaza Strip, I've kind of been wondering, like, what the end game is here. Because you go in, you decimate Hamas, and then what? Everybody just comes back to Gaza? Comes back to what? There's not going to be anything left. If I lived there, I would be doing everything that I could to go somewhere else, you know? To get out of Gaza. Let's see here. What's this? Nick Timoros. Private sector compensation growth held steady in the third quarter, rising 1% from the prior quarter. This lowering the 12-month rate of change to 4.3, down from 4.5% in quarter two and 5.2% in the year earlier period. So just reiterating the news that we got overnight. Elon Musk tweeting, the bellwether has sounded, retweeting about the joining the Panderverse episode of South Park. I don't know if that's what it really means, but okay. If anything was a bellwether, it was the media reaction to Snow White and the Seven Dwarfs and Disney canning that for a year. And like redoing. I'm told that they're redoing it and that the dwarves will all be CGI now. Okay. Dude, this is still going. I'm having a hard time understanding what is causing a flow this strong to come through short. I mean, this could be coming outsized because they were looking for an opportunity to, you know, hit the Japanese yen. The Japanese yen is falling here, so oh yeah, I really don't see how the Bank of Japan news would make the Treasury's bid. Japanese bonds are at the lows of the day. Totally. Well, so all in risk, just from the Japanese perspective, because the Japanese bonds did the same thing. Yields declined, and the Japanese yen declined. It does not make much sense at all. But the market seems to be saying that they think that the Bank of Japan's decision was not strong enough, right? It was more dovish than anticipated, and they're reading this as bad the yen. When really, I don't see how any other way other than that this ultimately results in higher yields. So it really is. But hey, sometimes the knee-jerk reaction of the market off of a thing like this is not, is stupid, right? Because what happens is you got all of these robots and these big traders, and they've got their game plan, and they read it, and they say, oh, well, it wasn't what I was expecting. It was more dovish than what I was expecting, so I guess I buy treasuries. And they don't think about it further than that, and that's why sometimes you have to give them a few days. Like the market reaction after the Federal Reserve meeting is usually not the final say on it, And a bad yen means intervention? Could be. Well, on my 6J, we're coming awfully close to 150. And 150 has been where they've intervened before. But, I do wonder, like, we got this number, U.S. employment costs, actual 1.1%, expected 1%. So it was 0.1% higher than anticipated. For a number like that, 0.1% is bad. Okay. It's pretty rare that those kinds of numbers are like 2 or 0.3% worse, right? But that's also not a number that is like super widely followed. So the market reacting just off of that does not really make a whole lot of sense to me. But if there's a bunch of people sitting out here saying, nah, yields should be higher based off of that Bank of Japan thing, and they think that we should be at like 4.95 instead of 4.8, which is where we were, then maybe they were looking for the opportunity to sell it. So the amount of flow that has come through here now, we were at what, 26, and we're now at 9. So we're about 17K contracts net sold. That's a little odd, right? So certainly not something that I was anticipating or looking for, because you could have bought almost anywhere along here. Probably would have been an easy winner, but there's no way that I saw that one coming. It's all of the action today is a little confusing to me. And that's always going to be, let me put it this way. As soon as you put discretion into a system, those choices become the weakest link in the system, It is. And so what you're doing is you're creating a big weakness in a system in exchange for a lot more opportunity for us. It's a tough trade-off. It's a tough trade-off to deal with, but it's kind of the one that I think we have to make. And sometimes we won't know what's going on. Right now, I'm not sure I understand what's going on. It's very odd, the way they're reacting here. But, you know what? I bet you that this just continues to churn. Getting action like this on a day before the FOMC, that can continue to churn. Let's come over here, see if Zero Hedge has a story about this yet. Nope, not yet. Eurozone economy shrinks for the first time since COVID. Inflation tumbles, but Euro rallies. Traders, our job is so not true at all. The more you understand about what's going on and why, the better off you will be. There is significant edge in being informed. And if you don't know why, and it's a big move, usually a good idea to try and figure out why, because it might be useful in the future. But we're not always going to be able to know why in the moment. Definitely in the moment, we're not always going to understand it. Definitely not. But that doesn't mean that we shouldn't try. Because then you just end up being a noise trader. Right? Reminds me of this thread yesterday. Yeah, if you don't immediately know why, then the opportunity is gone. That's very often the case for sure. Right. I mean, I think that there could be movement the whole rest of the session, right? But I can't really make a calculation as to what the probability is that it reverses a bit versus it continues selling versus it just kind of goes sideways if I don't really know what that flow was, and ergo have no way to estimate how big it actually will be. Right? So this kind of reminds me of a thread I saw yesterday on Reddit. I mean, there's one of these like every week, it seems, on the day trading subreddit. But this one was particularly long for some reason. And it was basically the guy had a picture of Bitcoin yesterday. And they're like, what did I do wrong? And then everybody came in with their technical analysis of what they saw on the chart that would suggest that it was going to move down instead of up like this trader thought it was going to be. And all of the answers in the thread I just thought were so crazy. I was like, everything that you're talking about is like subjective. And if we had moved higher instead, you'd be saying the exact opposite. Like, none of these things that you're talking about are predictive in the least bit. It's just crazy. Wrong pair of socks, maybe. They really taught me a lot about the behavior of markets. Oh, thank you, Alan. I'm glad that it's useful to you. That's what we're here for. That's what we're doing. Now go forth and spread the gospel of the true nature of markets so that the rest of society can understand this and we can stop with this nonsense. There's a new low and stops at 08.5. Not a ton of stops, but actually some volume at 09. So that might be enough right there to slow things down for now. I guess the thing that continues to surprise me is how even really smart people that have been at this game for a really, really long time will fall into really simple logical traps, you know? Like, I really think the reality of it is that you have to get into really sophisticated math and theory and stuff to understand why the market does what it does. Like, I can tell you what it does, but until you've really dive into like the mathematics of it, I don't think that it completely, you know, so this is like you won't completely believe it or something. Because that's what it was for me, is I had been told kind of the behaviors, but I didn't really trust it the way that I do now, you know? We all fall for junk food sometimes. Nothing strange about that. Yeah, you know that Gary Norton, he likes to talk about financial junk food, right? But I guess that's the other side of this. And the part that I really don't understand is why people are so much more interested in all of the different ways that I can analyze a chart and not how do I analyze the actual news that I'm getting. I mean, there's tons of people out there that love to read the news. People on the internet are talking about this. There's not more traders out there, retail day traders, saying, you know, well, I'm trading based on the news. I don't necessarily say I trade based on the news because there are flows that come through that aren't based on news, and we still trade those flows, right? So I feel like I'm trying to go higher picture than just news. Predictors of order flow. Okay, we can call it that. Nobody will know what that means, but whatever. But the retail traders are almost exclusively technical analysis, and I just don't get it. I don't see the appeal. I don't understand why it's so hard to dissuade people from it. Because there's plenty of people out there that have been doing this for, 3 or 4 times longer than me and never really had any success with it. And the whole time they've just been trying one technical analysis system after another. And at some point, when do you say, hey, maybe the technical analysis doesn't work? It's insane how they think it only takes knowing how to read a chart to become proficient, and how the rest is all about psychology, for sure. Well, I mean, I think I understand that, why that one happens, right? Because if the only edge that you have is technical analysis, and you truly believe in it, and you're not having success with it, then how do you explain that, right? Because there's only 2 explanations. You're doing it wrong, or it doesn't actually work. But since they truly believe in it, the it doesn't actually work thing is just they refuse to even consider that possibility. So it all comes down to, I must be doing it wrong. And so then you go down into all of your psychology and as like my subconscious undermining myself and all of this kind of nonsense. Right? So you started trading in 2015. I mean, yeah, I think you've been trading longer than me, though, because I basically started the later part of 2016, in futures at least. I've been watching the overall financial market since 2008, but it's a long road, the retail road, fortunately. You know, you just look at some of these guys, like Akshay, because he's really been in the industry, right? And so much of the stuff that he knows that to me is like, whoa, wait, this and this, and and it's like trivial stuff to him. Like he probably doesn't even think about that he knows it. You don't even know that you know it, sort of thing. Technical analysis was so confusing until I saw you guys and discovered the DOM. Well, and I think one of the things that kind of makes this puzzle, the puzzle of discovering that technical analysis doesn't actually work, a little difficult to unravel, is because, reality does not conform to what we want. We try and pigeonhole reality and it never works. You took the hero trade. Oh, you shouldn't have told us, Octavius, because as soon as you did that, they ticked it down 2 ticks. I was reading this trader recommending books to learn how to trade, like Trading in the Zone and TA books. They probably want to read Fooled by... Yeah. Oh, yeah, exactly. It is like, if you are into technical analysis, then the first book that you should read is Fooled by Randomness. 100%. 100%. Yeah. So, but the thing is we want reality to conform to like this model that we have in our heads, right? That we've been, or that we've been taught, essentially. And the model that we've been taught is there's fundamentals and there's technicals. And fundamentals don't really work for us on day trading, so we just have to trade technicals. And that's the model that all of the retail traders are using. But then when you go into like what's technical, it's everything that's not fundamental, right? And so then it turns into any sort of way that I can take a chart and analyze it is a potential method of trading it, essentially, right? Well, sure, you can do like quantitative analysis of things, and there are edges that you can pull out there, right? But they aren't really the edges that like retail thinks they're getting from the chart, where they're saying if it's a higher low, then it's more likely to do this and all of those sorts of things. No. What is it actually? Well, it's, look at liquidity, and, there's a kind of an upper limit to the impact of a trade, because it creates a liquidity hole and there's nothing to trade into. Now, like we were talking about that scenario yesterday, they actually asked us what would happen if the S&P sold 1.5% every day for 60 days. Then the VIX would basically go to zero, because there would be no variance, and variance component is on every step of there. I looked at it yesterday and I understood now. It's like, this times this, and if the variance is zero, then all of these are zero. But in reality, that could never actually happen, because why? The liquidity would disappear. The liquidity would disappear and the volatility would increase, and you would very, very quickly start to have days much larger than 1.5%, right? So there are some stylized behaviors of markets, right? But they have nothing to do with if you form a higher high and, So you go and you see these people that are like, there's algorithmic trading firms, and you think, oh, well, they must be doing the same thing that I'm doing, but more sophisticated. They've just found the right way of looking at the chart, and I need to just keep digging until I find it. When that's really not what they do. It's really not what they do at all. As far as I can tell, what they're doing is they're taking proprietary order flow data and using that information to suss out information about how different players behave and to predict their orders throughout the month, and then find opportunities where there's a really big imbalance. And that's stuff that you just simply could not predict from the information on the chart, because the information is all hidden in there in knowing who's doing what at what time, right? And you're never going to unjumble that without that data. And so you're just digging and digging. You're digging in the sand. It's like going out into the desert and digging for gold. And, well, I don't think that you're very likely to find gold out in the desert. That's not the kind of place that gold tends to be. People can't learn unless they get good criticism. There is a certain point at which I think that you're ruined. Like, if you're watching my stream and you're like 50 years old, and for the last 20 years you've been trading technical analysis and having zero success with it, and now you go, oh, maybe Seth is right. Maybe I should stop this technical analysis stuff, understand how to read order flow, and look for information that will predict order flows, and go and take this kind of approach to things, right? It's probably too late. Like your ability to undo all of this intelligence that you have crystallized in your mind around technical analysis and look at the market with a completely different set of eyes, I think you'd have a very limited ability to do that. You know? I don't understand that analogy because I don't understand enough about poker. But Lucas says retail intentions of learning what whales are doing is the same as trying to understand what hands and cards professional poker players have while playing a game. I think one of the interesting things that also happens is that, you know, a retail trader will talk to somebody in the industry, right? So they'll talk to somebody that understands all of this stuff, like truly understands it and the math behind it and everything. And then they're trying to relate to a friend what the market actually does in the space of like 30 minutes. They can't. They really can't, right? But they can come in and they can say, well, there's really big players, and when they move the market, they really, really move the market. So we just need to know what the whales are doing. Well, that's correct, actually. That's correct, actually. But the question is, how do you predict what they're going to do? Because the mistake that the retail trader makes is, oh, I'm going to see it in the chart. And by the time you see it in the chart, it's too late. Usually by the time you see it in the chart, it's too late. So you have to be able to predict it, right? So there's like this game of telephone, right? What we get is kind of right, but then because the only framework that we have to work with is looking at a chart and trying to predict the markets based off of the past price movement on the chart, you just, the piece of information ends up actually getting you nowhere, right? Right? Whales need to inform me, yes. I feel super uninformed today. In all seriousness. Like, these sorts of moves are the most frustrating to me, because we start out, okay, number comes out, we go down to 14, and I'm like, well, why did they sell down so much? What's the big deal? Is this actually isn't that important or not? And there's no way for me to know. And how much more of this flow do we have to come through? We've had about 25,000 now net, you know? So 10,000 contracts ago, I could have said, if I really understood what was going on, hey, this is going to keep going, and I could have sold it and made $10, but because I didn't know, because I don't know what the guy that's selling knows, I'm stuck. You use it. Do you have a 5-year track record? And how do you define technical analysis? I don't know. I used to take the approach of there is nothing in the behavior of price, in the analysis of price itself, that will really help you. But I've realized that that's not really the case. There are stylized behaviors in price alone. Is just that the stylized behaviors that you can find are usually very limited. And so a guy like Renaissance Technologies, rather, what they're doing is they're taking hundreds of these little stylized behaviors that they've discovered and putting them all together. And once you do all of that with machine learning, then you have something that's actually quite predictive. But we expect to just say, oh, here's a pattern, and then you trade that pattern, and it always works. Right. So like what we would try and do with technical analysis isn't even remotely close to sophisticated enough to work. But Lacey, you think it's technical analysis? Yeah, and then this goes back to like the model that we've created to explain the markets, that like there's a fundamental data and there's technical data, and technical analysis is basically everything that's not fundamental, is not helpful to us, right? So the model that I would like to replace it with is this. Orders move markets. The reason that the market is moving is because the buyers are more aggressive than the sellers. Market buyers, there's more market buyers than there are market sells. Overall, essentially, right? And so in order to make a prediction, we have to have information that is predictive of future orders. Now, you could have multiple different things, right? You could have one guy that is rebalancing his portfolio for the end of the month. That's a flow that we have to watch for today. It's the 31st, right? I don't think these are going to be as strong as they usually are in past months, but there's going to be end of month flows today. You go to the close of the options pit and the close of the S&P 500 overall, you're going to see a lot more volume today because it's the end of the month. Okay. That is a flow that we can predict. But then there's also other flows that we could possibly predict based off of like the economic news that we got, for instance, right? And so now you kind of have to combine them all and say, okay, is there actually like a net imbalance there that's significant enough for us to trade off of, right? That's kind of the model that we use. And so it's predictors of order flow. So now we have to look at each individual thing and say, does it predict orders? How many orders does it predict? Why does it predict orders? Right? And when you come in and you try and apply that to the technical analysis side of things, and you say, well, we had a higher low. So what does that mean? Does the higher low mean that you're likely to see X thousand more buys than sells? Come to, market orders to come in here? I mean, that you would never hear anybody say that, right? That doesn't really make any sense. That doesn't really make any sense. What I think GWE is doing, based off of the stuff that he's shown us, is he's looking at statistical arbitrage. Basically, he's looking at correlations and stuff like that. Well, okay, now you can say, yeah, if this one moves up and this one didn't, then it's very likely that there's going to be future orders that is going to push it up and move it back in line. Now you're actually predicting orders, right? See the difference? So it's not like a numerical analysis of even just price can't tell us something. It's just what orders is it actually predicting, right? Can you quantify it? But then when you start to look at that, the things that we actually can discover just from the movement of price itself on a single time series is like the stylized behaviors of volatility, right? Like if we had a bunch of volatility, we're likely to continue to have some volatility because volatility clusters. We tend to have more volatility when we're moving down than when we're moving up. Liquidity tends to be bad when we're moving down. Those are the sorts of things that we can utilize, right? But does that tell me that it's going to go up or down? That tells me a few very limited things about the orders, right? If I saw a lot of orders yesterday, good chance that I'll see a lot of orders today. Okay, but are they going to be buys or sells? That doesn't actually tell me that, does it? Right? So now I'm going to have to combine it with some other information. Who's going to be buying and selling? Why? Right? Now when we have predictors of order flow allow us to generate a model that is actually useful, right? Of course, the model that we have is going to be incomplete because we don't know everything about the market. But I'd say you stand a better chance than what you get with chart patterns that people are using. Liquidity attracts... I don't know about that. I think that what happens... Here's what I think happens. I think that a company like, let's say the big bank like Goldman Sachs, they have a certain amount of capital under management. and they have a certain amount of credit that they get from, being able to borrow from other banks and from the Federal Reserve, et cetera, et cetera. And so there's a limit on the capital that they have. And then they sit down and they say, how will we allocate this capital? Well, we have a lot of capital and we have more than enough capital to do all of the merger and acquisitions that we have. And we have more than enough capital to carry out all of the trades that we need to do, like block trades for clients. And we're servicing, and we have a ton more than we actually need. So what do we do with it? I know, we'll give it to the robot and let the robot, use that liquidity to scalp, right? And that's kind of what determines how much liquidity there is out there. That's why when the Federal Reserve tightens the money supply, like we're seeing right now, where they're rolling off their balance sheet, that you've seen the liquidity in the treasuries become so damaged, because essentially the people that were providing the liquidity basically can't justify using it to provide liquidity in the treasury market right now. They need it for other things, because there's just less capital available to them. But what did I just describe? I just described something that predicts orders, right? So the tighter the monetary supply is, the less money there will be available for market makers to provide liquidity in markets. Right? That's predicting order flows. I'm predicting the limit orders. Let's see here. Yield is already at 0.9, close to the 1% threshold. It seems like the Bank of Japan is going to edit its policy or intervene soon. Not sure what to tell you about it works, for example. Whenever what gives a reading below 1,000? There are certain types of markets that are more... don't you have kind of a chicken and an egg problem there, though? So how do you know that the factors that you're talking about there are causing more scalping versus the more scalping is affecting those indicators that you have? Right? Like, even if you can show there's a correlation between two things, how do you prove cause and effect, right? To prove cause and effect, you kind of have to have a theory about what the cause and effect is, and then you have to show that when I modify this variable, it does have the effect, and when I go and I modify this other variable that is the effect, it doesn't affect the cause back, right? And then you have a very clear one-directional cause and effect. Which is to say, I could come in and I could somehow add $1,000 of liquidity out there into the treasury market, and I don't think that you would really see a whole lot of other volume follow me and provide more liquidity to the market. Because me putting more liquidity out there is not going to affect these other players' ability. They're still going to be capital constrained. Well, I thought that we are kind of going sideways here, actually. So this one's a little curious. So we do appear to have developed some degree of, rotation point around 09.5. I wouldn't necessarily call it a liquidity hole, but they're definitely like coming into the square root law of impact. But now that the volume has been, or cumulative delta rather, has been sideways, we are drifting a little bit lower. And not with the Japanese yen moving, but the dollar is moving. No, don't get me talking about the war in Israel yet. Let us finish what we're doing. Could it be a second leg of a meta order? Could be. This would be about the time, wouldn't it? But the thing that I'm seeing is that so far I'm not actually seeing the volume hitting it, but I am seeing the dollar move. I don't know. Normally, I guess maybe I haven't been paying close enough attention, but normally in this area, I would start to be looking at like, okay, has there been takes? You know, have they hit the bid? And so that right there, I would say maybe is. So it's like they're being a little bit more aggressive there at 08 and 08 half than they probably need to be, right? It's just the media making its theme. Well, you know, the markets are justified in having reacted to this whole thing, you know? Like, especially in the beginning, when oil was rising and things like that. Do you see this comment yesterday? I mean, I'm trying to keep it relevant to markets, and then maybe when we're done talking about all this stuff, then I'll go on the rant, right? But Hamas was saying like, oh yeah, we totally anticipated that Israel would act this way, but we didn't expect the United States to come in and like, so basically, Hamas expected all of these other countries and stuff to start to just straight up move into Israel all at once. And they didn't, because the U.S. aircraft carrier, strike force, whatever, is there in the sea. And so they're all too afraid to do it. Or at least that's what Hamas believes, right? So maybe the possibility of this whole thing blowing up was a lot higher than we realized because of that one thing that prevented it from happening, right? And so the markets, you know, because so far some of these reactions that you've seen off of that from the markets kind of seem like, well, but nothing happened. So I don't think that their market reaction was really justified, but I think actually it probably was. Okay, so I'm seeing a lot of ticking around, but not on a lot of volume. So at first I was like, okay, 2 or 3 ticks down, and they took it with only like less than 400 contracts each time. Now I've seen them go back and forth across that whole range without doing it. I am seeing an iceberg on 08 half. Okay, they cleared it. It ticked back down. That does seem to be like a possible, you know, that could possibly slip. My news squawk is pointing out that the Canadian dollar is not doing so hot right now. I am familiar with Markov chains. I've not built that one yet. Dude, I just don't have the attention span and focus. And especially, I mean, it's worse than usual. I mean, overall, I don't think that I'm very good at that. But then lately, it's been worse than usual. Okay. Well, I'd still say it's behaving rather suspiciously with the way that it's moved to new lows there. But there I did get filled. I'll do it again if I can. could be used. Well, I suspect that there is some sort of a hidden Markov model sort of thing going on with the order book. Because I will get... So this is one of the really bizarre things that I've found with order flow. Okay. When I actually started to like keep statistics on them and stuff like that, is you'll get a period where the signal that you're using works literally every time. I mean, it's like you'll go over a week and it's like 100% win rate. And you're not even like, taking on excessive risk or anything like that. It's like equal risk reward and you win almost every single time, right? And then you'll have a week where it loses almost every single time. What's with that? Right? Seems to me that there's got to be like some sort of a hidden Markov system in there. That if I include a couple of different things and stuff like that, then I can calculate the probability of which regime that we're in and when to use which signal and whatnot. And in fact, I have strong reason to believe that, particularly with the net imbalance between buys and sells, versus what the current trend is, that there is some sort of a Markov model there. I have strong reason to believe that there's something there, and I just have to, because I remember hearing people talk about it, although I've never found a study about it. So I think that it might be something that a lot of banks and market makers have discovered, but it's not really public. And, Renaissance Technologies talks about these a lot. Yeah, I think I have strong reason to believe that these Markov models could be useful with order flow. Okay, I pulled that one off twice, although the second one didn't go quite as well. I'd say I still feel like it's a little sketchier, but I should also note that on that one, the 30-year pushed lower and not really the others. So the flow seems to be coming in on the 30-year. Right now, I'd say it's kind of net zero over in ZN. Oh, it won't be like that for long if you've got 3,000 contracts just sold there at 06 half and 06. Those might have been stops, because those ones at 06 came through pretty quickly, right? Bye-bye yesterday's rally. Well, are you talking about oil? Oil's been a wild one, right? It does seem to me that the risk premium of oil because of geopolitics is coming out, though, right? I mean, that's kind of what we were saying before. Okay, uptick. I hate trading against the trend. I don't know why this thought is coming to me, but, Octavius talked about the hero trade earlier, right? Now I'm this is where I start to think about the hero trade. Except for that, I don't think I'm really sold on buying flows today. I kind of feel like that what we've been shown is that the flows are short today, and those flows are either going to continue to be short or, they're done. The flows have come through and they're done. So if I did take the hero trade, it'd have to be a teeny one. Maybe we get back to 09.5, for instance, right? But I think that we're kind of ruling out the long side flows at this point. Or rather, a net imbalance long. There does appear to me to be a little bit more liquidity here at 06 half though. Because when we were at like 08, it was a little weak. But the absorption that we've gotten has increased as we pushed lower. No, they can't. They've basically exhausted the SPR, yeah. You got back in on the second leg and cut that a little bit lower. Yeah. I guess what I should say is I don't really like the hero trade just because it looks like the net imbalance for this session is going to be sell no matter, you know, and I don't really see anything that would be causing buying flows. But if I had somehow gotten myself short, like say from 14, I think that this, what is likely to be a 5K iceberg at 06 half would almost certainly get me out. That doesn't mean that that iceberg is like a really solid reason to move up, but rather that's something that will like just really blunt the momentum. Like it'll be very difficult now for them to get very far away from 06 half. A person close to the People's Bank of China says that they are likely to add liquidity. Yeah, I haven't seen, speaking of oil though, I haven't heard an update from Goldman's commodity team in a while. Because remember, they were saying $100. It got really close, and then it's kind of come back. And then I think that they said that, you know, we could still see it going to $100 in the next year, barring a recession. I wonder if they've changed their mind on that at all. Okay, tick back up. So you see it will like come down and it'll make it seem like, oh yeah, it's just really weak. They're going to go, 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 go. And then it doesn't. It ticks back up and all of a sudden it's like, oh yeah, we're really stuck. And then, you know, it goes back and forth at 06 half for like 5 minutes. And you're like, what the hell? What's the chances that the Euro USD hits par? I'm going to say that given what we know right now, I'd say it's unlikely. Maybe 30% chance that it happens. But that could shift really, really quickly, right? Because if things go south, then there's a couple of different ways that it could go south. But if things go south, you're likely to see the dollar strengthen. Okay, now that is a little unexpected because there definitely were starting to do some of the behavior showing that they might be stuck at 06. And now they're just busting 05 like it wasn't even there. And again, well, I'm seeing the Japanese yen falling a little bit. But what I'm really seeing is the dollar just looks incredibly strong here. Now, they might snap back up to it, but that little shift of orders was a little unusual. When I see something like that, that really makes me want to get in. But that just reminds me of like, oh yeah, but that's exactly the spot where it would come back on me, and I hate the price that I caught, right? Let's come back to Zero Hedge and see if they have anything about year-end stock rally rests on liquidity and earnings. U.S. home prices rose for fifth straight month in August, but Yeah, I don't know. Let's come back. Let's read this one. U.S. employment costs unexpectedly accelerated in the third quarter, heightening concerns that a strong labor market risks keeping inflation above the Fed's target. The Employment Cost Index, a broad gauge of wages and benefits, increased 1.1% in the July to September period, above the 1% rise expected, after rising 1% in the second quarter. Compared with the year earlier, the ECI was up 4.3%, the smallest annual advance since the end of 2021. Still, that's well above the typical pace seen in the years before the pandemic, where it was well below 3%. While growth picked up slightly within private industry, salaries at state and local governments surged. But we already knew this was happening. Zero Hedge. Why is wage price inflation so sticky? Well, it's not because of private workers. Here, wages and salaries rose just 3.9%, the lowest in 2.5 years. It's all government workers, where wage growth was 7.8%, just shy of a record high. Really? Bear in mind that while there are a number of other earnings metrics published more frequently, including average hourly earnings figures from the monthly jobs report, economists tend to prefer the ECI because it's not distorted by shifts in the composition of employment among occupations or industries. This prompted a spike higher across the yield curve, with the short end affected the most. Bidenomics and the Reinflation Reduction Act is buggering up the Fed's cutting plan. Well, we did snap back to 06 half. That might have been okay. So something that I've seen that you'll see a lot. I don't have any empirical backing for this one, so let's just say this is just kind of like one of my trades. Okay, because you're seeing a large meta order. You know, you see one leg and it evens out, and then you see another leg and it evens out. And then before the time is ready that you would see the third leg, like during that it's evening out, almost as soon as it starts to even out, there's another burst and it pushes it down to a new low, but only briefly. And from there it reverses. That looks like what we're having right now. Because look, now they're ticking 07. Now, to balance things back out, they'd only have to get up to 08 half, so that's not very pretty, is it? Ooh. Spooky, Brian. Well, Zero Hedge seems to think that this move in the treasuries is because of that ECI. I can't ever remember looking at that number and reacting to that number, so that's why I'm a little bit like, Yeah, and there are crazy things going on in Cat and JetBlue today. Gary points those out. Yeah, so Cat plunges after their back order catalog unexpectedly shrinks for the first time since 2020 is what's going on over there. And JetBlue shares hit turbulence amid warnings of a wider than expected quarter four loss. Let's see here. I guess we had house price index. Oh, okay. So we get Chicago PMI here. Let's see here. It's time for me to start looking at the other things that we got. We got consumer confidence at the top of the hour. We got 52-week bill auction today. After the bell, it's AMD earnings. Okay, so this Chicago PMI will be in 6 minutes. So again, U.S. Chicago PMI goes public at 9:45 Eastern time, but you can subscribe and get that news 3 minutes early. So at 9:42, you probably will see a market reaction, even though we won't know what the news is. A lot of beginners are often thrown off by that because they're like, the news is not yet. Why are they moving here? Just know that there is a release there. So it's a little, this is the only new number that I'm aware of that's like this. So it's easy to forget about it too, right? Okay, so there was some news at the top of the hour. I don't think that you were really seeing the treasuries react to it, but Case-Shiller 20-year is 2.16 versus expected 1.75, and house price index month over month was spot 6 versus spot 5. So the housing market continues to appear more bullish than anticipated, or is doing better than anticipated. And we still appear to be stuck in the liquidity hole at 06.5. So we may just remain there until the PMI. There's still no Wi-Fi in your house? That sucks, dude. I don't know. I guess it's enjoy the, internet free experience while it lasts. Here's an interesting post from Nassim Taleb while we're waiting. The problem is architects building structures to impress other architects, but plumbers don't act on impressing other plumbers. Any activity where agents impress peers rather than satisfying the need of constituents ends up rotting. People don't like the modern aesthetic, and then, as now, they were the majority, were held to be committing the same kind of aesthetic crime as those blah, 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 blah. We have skin in the game and the architect doesn't, really. Are you saying that if an architect designs something that really sucks, that it doesn't matter because they still get the job? Okay, so I am seeing the liquidity thin out here is 30 seconds before the news. So should be careful because this could be another like big move based on what I'm seeing at the moment. I'm sure that the liquidity above us is recovered by now, but we could still see a big move here. Yeah, now it's really pulling out. 5 seconds. Okay, here's the number coming. Not really seeing anything there. maybe the number just comes in line. So they're expecting 45. Maybe they just got 45. The liquidity's not coming back yet, though. Well, let's wait. It's another minute, 45 seconds until we get what the number was. But I'm going to bet that it's basically nothing. Mm-hmm. 30 seconds. Okay, so the number is 44 versus an expected 45. So that could maybe actually prompt a little bit of buying, but, you know, didn't really prompt buying off of the thing. I'm curious to me that the people that subscribed early didn't really find that worth trading. There's 2 ticks up from that, though. We are seeing the dollar reversing. We also came across the average cost basis for the sellers in ZN. So that kind of suggests to me that this long could maybe actually have legs. And I'm not seeing a noticeable shift in the spread. It does look like that we flattened on the short end. I'm starting to see quite a bit of volume trade at 09. Well, I don't know about this. We're in a spot here that has been notoriously difficult for me to find any way to predict what will happen. There was some volume long here, so maybe they start to retrace some of this, but I don't know how much is actually going to come through. Like they came through because of that Chicago PMI. We do have consumer confidence in 15 minutes. Okay, so I'm going to bet you, well, okay, never mind. This is too late. I was going to say, I'm going to bet you that they range between 06 half and 09 until the consumer confidence. But I guess it's already too too late for me to, because it already came down 2 ticks. And if Congress doesn't get their spending in order, the long end of the curve will tell them how painful it is. I don't know. It kind of seems to me that the problem there is that Congress doesn't get punished for what they're doing. That the situation with the dollar is such that it's preventing like the real doomsday scenario with yields and everything from happening, right? And I personally think that, okay, so inflation goes higher, not because of what's going on in Congress, not because of the deficit, but just like inflation goes higher because it's being sticky and all of that sort of stuff, right? That one's a possibility, a strong possibility. The one where those concerns quickly shift into deflation, and that the lagged effects of monetary policy have just yet to hit the market, and we go into a recession in 2024, that one is a real possibility. I think that both of those are more serious possibilities than that because of out-of-control government spending that yields spike on their own without a shift in consumer expectations and all of that. But on the short term, there is a lot of government issuance out there, right? So I think that we continue to be in this situation where every time that we have bond auctions, there's going to be some concern that the auction is weak, right? So I don't think that one is going to like, yeah, like you said, the finale, but like how long does it take to get there? Sort of a thing. But it does end up being a short-term flow that we have to consider in our trading. It's kind of curious, isn't it? Okay, so they seem to be just a little bit above the 06 half, but they seem to be moving around pretty freely. Oh, you know what? I have a meeting today. Dang it. I hope we get these through with, because these are like really disruptive, and I'm sorry. I feel bad for you guys, but we'll keep streaming through it. I just won't be talking as much. I see no way to go with zero rates for 2024. Well, I agree with that one. So, like, if we do get the recession scenario next year, I don't think they'll go to zero. Yeah, 2.5 to 3. I think 3.5 might be a little bit too high, but like 2.5 sounds realistic to me. I mean, in order for them to get back to zero, I think that you would have to see like a recession that like turns into a really deep double recession worldwide, kind of borderline depression sort of a thing, you know, because there's still a lot of people out there that have not been able to make up for their lost earnings, right? So I think that you're going to continue to see wage pressures for a long time. And I think that will make it very difficult for them to lower rates too much. Same with like the labor market. Like, I think we could get a recession here. You could see unemployment move up, but I don't think that it would be as dramatic of a rise in unemployment as, say, 2008 was, because the labor market is just really tight overall still and is likely to remain tight for a long time. So, yes, in the event of a recession, I think we've got a couple of things conspiring together that will make it very difficult for them to lower rates too much. What are you going to be for Halloween? Absolutely nothing. So I know this is so terrible and like I'm the most boring person ever, but I've kind of discovered that the adult doesn't actually have to dress up, that, you know, it's just the kids. And I would rather not waste my time and effort on that. So, but the kids are Pikmin. They're supposed to be Pikmin with their cousins. We'll see what happens. I'm not super on today because we did not have a good night's rest. The kids, both of them fell asleep at around 7 o'clock, I would say. So before they had the chance to eat dinner, they fell asleep and I put them in their beds. And then they both woke up at about 1 o'clock. So like Asher's been awake since 1 o'clock, and then Ethan was awake. And eventually my wife took them downstairs. So she's been awake since and that was at 4 o'clock. So it's now 7. So she's been downstairs with them for 3 hours already. So I don't know what they're going to do tonight. I'm concerned that they'll be super, super tired and they'll fall asleep before trick-or-treating, you know? But I think I will see what happens when I come out, how they reacted. Because when I came out and I started eating, the kids came over and started to try and steal my food. So maybe they woke up because they were hungry. And Mom just not realized that she needs to feed them because it's not normal breakfast time yet. So if they're more tired or one of them's taking a nap, then maybe we don't have as big of a problem. But I think that I'm going to say, like, let's have a really early dinner and take them out really early. And that will, like, tire them out enough so that by 7:30 or 8 o'clock, they're tired. And we can put them down to bed and get a good night's rest tonight. I don't think that'll work for my kids. Asher, my 3.5-year-old, he's just straight up autistic. Like, he hasn't been diagnosed with it yet. We're getting there. We're getting close. He is autistic. What the long-term diagnosis of that is and all of the long-term implications, I don't know. But right now, he is a nonverbal autistic. And his sleep, it gets so messed up. So like if I get him on a schedule, it's amazing, because like he'll put himself to bed like the day before yesterday, like Sunday night, he put himself to bed. He saw Mom go upstairs, he went up there, he got in her bed and he fell asleep. He crumbled crackers all over everywhere first, but then he fell asleep. Right? But then if he's not on the schedule, it's like he'll be up all night. It's insane. So the typical things that I would try, like giving him melatonin and things, that doesn't seem to work. I've also done things like my wife has related multiple stories to me where he will drink a Coke or even a Red Bull and then immediately go to sleep after that. So if you have a backyard, give them shovels. Unfortunately, he's not quite old enough for that. So I have like a garden in the backyard, and around the garden boxes there's gravel, and they like to take the shovel and throw the gravel outside of the box. So then there's all this gravel on the ground that you have to pick up by hand to put it back in so that the grass doesn't die. Oh, so annoying. Just give them an IOU. There you go. Okay, I do have a meeting here, but we will watch the reaction first. And I will keep the stream going, but I won't be speaking very much, all right? Get good sunlight. Well, they do like being outside. That helps. I'm going to pause the music here for a bit. Cool. Okay, here we go. Here comes consumer confidence. Expectation is 100.5. Previous reading was 103. Man, and liquidity is really pulling. We're getting 102.6. That's higher than forecast. They're probably going to... That could cause some selling, but I'm not seeing very many orders come out yet, so... There's a little bit of downside there, but I don't know. I'm not... Can you really do a Markov chain with Excel? Does that work? No, there's a little bit more selling. Well, you're seeing the dollar move up again, and that's kind of pushing the treasuries down, but I'm not actually seeing a lot of trades get put on because of this CB. Yeah, Amir Goya says I don't see any reaction. I would say I see a tepid reaction, but I'm not liking what I'm seeing. Seems to me like the market doesn't care about that particular piece. So I'm seeing after that news, the dollar's rising here and the yen took a big hit. In fact, the treasuries are not moving down as much as the Japanese yen would suggest. So this is extremely curious. And where are we? We are significantly lower than the low from the Bank of Japan announcement. So that's a little hair-raising to me. We could be in an area where Japanese yen might intervene. It's a 150 on my chart. And I know that my chart is a little low because of the futures and everything. So Okay, my meeting is over, so I'm back if you want to ask some questions. So far, they did have a lot of liquidity seem to add on the bids down here, at least stopping the progression lower. But since that time, we've come to 09 and they've just kind of stopped. So I'm a little skeptical about if there will be another leg higher. I think it's been more than long enough that it, well, I suppose that you might see one at the top of the hour. But so far, they didn't really do a whole lot with it. So that kind of looks to me more like they were just protecting the downside and they didn't really, or maybe taking profits or something. I don't know. But the trade was, you know, this pullback, and maybe that was all there was to it. Now, the indexes are doing some interesting things here that I want to show you. So when that move off of the lows kind of happened in the treasuries, you saw some excited buying over here in the indexes, and they ran into a liquidity problem. So you can see this little bar here. When you get a liquidity hole like that in the S&P 500, again, you'll find yourself touching that price a ton. And eventually they did come down to the seller's cost basis, and now it's bouncing back up, and quite aggressively, I might add. That last bar is pretty strong. So it looks like somebody wants to buy equities today. And like I said, I think that the most likely scenario here is that you buy equities for end of month rebalancing. I don't think that it would be as strong as past months, but I think the equities are likely to be end of month rebalancing long. I don't know how that, goes up against all of the other things that are going on right now. It might be just really hard to predict things right now, but that's where it's at. So, morning retro. So we got about 15 minutes left if you want to ask your question, Lucas. But I have to say, the action is still a little confusing, if not disappointing in some respects, because that inflation number really, really moved us, but then the consumer expectations really didn't. Can you briefly explain why a scalper needs a bigger set of trades to determine his edge than someone who has less frequency of trades? Okay. So the metric that you would be looking at here is variance. Okay. So if I have a strategy that this is a graph of my profits and it goes up and down and up and down and up and down and up and down, right? And maybe it kind of comes back a little bit like this. And that's my profits, right? This is the strategy. This is what you want your equity curve, or whatever you're going to call it, to look like, okay? But scalping tends to look more like this. It's really, really consistent. You're winning all the time, and then one day you just get absolutely destroyed, right? And then, after that, it'll probably start working again. But the problem is that this thing right here, oops. This thing right here blows your account. Right? So the more variance that your strategy or the data series tends to have, the less susceptible you tend to be to fat tails. Tend to be. There still could be a fat tail in this one too. Okay, but these ones tend to be less susceptible to them. Right now, if you're going to scalp, there are some things that we do, right? Like the things that Gary Norton talks about, a lot of what he talks about is there to help you avoid fat tails, right? Like, for instance, he says, use an equal risk reward, okay? Because if you don't, if you're using more risk than your reward, you get like a super high win rate. And then your equity curve is really, really likely to look like this, right? Is that it'll win most of the time, except for that one day of the year where it doesn't work and they blow the account. Right? If one trade can wipe your account, well, it doesn't, that's not necessarily one trade, right? That could be like one day or 1 week where all of a sudden the performance of the strategy just starts not working for some reason. Yeah, so this is another thing, is that when we're like thinking about the risk in our strategy and the statistics of our strategy, one of the things that we'll tell ourselves is, well, I'm not susceptible to fat tails because I have a set target and stop. And so I can never lose more than X amount on one trade. So I don't have this same kind of distribution. I don't have this fat tail distribution thing. I have a distribution that looks like this. Here's my winners and here's my losers, right? That's what you think you're getting. But when we're using set stops and targets and things like that, really what we should be doing the statistics on is like daily profit and loss or weekly profit and loss. And then you'll see these tails, right? And I tell you what, almost every strategy that I've ever back tested will have a losing streak that is worse than what random possibility would suggest you'd get. So that's this, think of this as like your daily profit and loss, right? Okay. So the more concerned we are about a fat tail, the more data samples that we need to verify the profitability of the system, essentially. Right? We need to get more into statistics and probability at an academic level. Well, so it sounded like you had read Fooled by Randomness, yeah? If you've read Fooled by Randomness, you might want to read his technical encierto, where he actually goes into like some of the errors, the common statistical errors, and how to fix them. And then I think that's kind of enough to kind of explain this sort of stuff. Well, so Nassim Taleb, he has his Incertos series. One of the books in that Incertos series, or I don't know how you say it, is the Fooled by Randomness. So what it's called, Fooled by Randomness. Okay. Weren't you talking about that earlier, or was this somebody else? We brought it up earlier. I swear it was you. Yeah, it was you. It was you. So you've read Fooled by Randomness, so I think that you should probably understand the high level of these concepts. So he has a technical inserto. You can actually download this one for free online. Yeah, it's called just search for Nassim Taleb technical inserto. You can download it off of Archive. He put it on Archive, so you can download that one for free. Now, a lot of the stuff in the book, it was like over my head, to be honest. And not all of it is directly relevant to what we're talking about. But he actually goes into this stuff that okay, so this is where it gets super interesting. beyond my level, but I can kind of, it's just outside of my grasp sort of a thing, you know, is he basically says, if you can come up with an equation that describes the distribution of your results, right? If there's an equation, then you can see actually like what the fat tails really actually can be. And then you can, from that, there are these metrics that you can generate that will really help you quantify your risk to take advantage of these things. And basically what he was doing, the way that he was making money, was he was looking for situations where there was a tail involved that the market wasn't seeing, and then looking for a situation where that tail was likely to get triggered. Basically, trying to predict black swans. And that's the way that his strategy worked. But yeah, in general, scalping strategies tend to be more vulnerable to fat tails. Like, the shorter your holding period is, and the more trades per day you're taking, and the smaller your winners and losers are relative to the overall volatility in the market, the more vulnerable you are to a fat tail. Because eventually you come into this situation where you're only trying to take 4 ticks and the market is moving like 100 ticks at a time. Then if you actually get the 4 ticks, isn't it kind of random? Right? And then that causes that drawdown. So like for you, because you were trading pretty good for a while, the period in which you had trouble is a period in which even the big banks have trouble, right? So it shouldn't surprise us at all that, you had the drawdown in this period. Anyways, just warning you, that book is like a lot of the stuff in that book went way over my head. Way over my head. And the place that I got stuck was like, okay, so how do you create this equation? Like here, I have a distribution of the average range of a 5-minute bar in the S&P 500. How do I turn that into an equation and then use that to measure the kurtosis of this and then make decisions based off of that? Maybe if we interviewed him or something, he could tell us that, but... Yeah, I'm talking about the Taleb ratio. That's exactly what I'm talking about. There's some other stuff involved. I think there's this other one where it's like, you use the average absolute square instead of using the square root method, because that using standard deviation basically introduces... Okay, so one of the big things is that standard deviation gets really skewed when you're talking about really big fat tails, because the larger the value is, the more that square root affects it, right? Because if you were to graph square roots, it doesn't, a graph of a square root of x is not a straight line, right? It's not linear. So, yeah. They're saying instead of you taking the square root, you just use the absolute value of it. So if it's negative, then you just convert it to a positive, and then you do the standard deviation off of that, right? No, but there's this other stuff where he was saying that, like, okay, if you have a distribution and you have a graph of the distribution, if you know enough about why you're getting the distribution that you are to be able to turn it into an equation. An equation to represent the distribution. Then you can use these other tools that are more useful for describing bat-tailed distributions. Oh, maybe it's not called the tail ratio. There's this other thing that basically he says instead of using kurtosis, you use this symmetric, and that will tell you how fat-tailed the thing that you're working with really is. Yeah, you just have to go read the book. But unless you're like a math PhD, it might not all make sense. Because it didn't all make sense to me. They did this reading where they'd have like a live meeting where they'd go through the book with him and talk about it, but I didn't catch all of those, so then maybe I would understand it all. Okay, well, it's time for me to get going. Yeah, this is an interesting day. They are a little bit higher. I kind of suspect that the flows from here might be long, but it doesn't look like they're really getting the boost that I thought we might when I started to see the liquidity stack down here. So Raymond says news. No, I don't have anything. There is a bill auction at the bottom of the hour, so if you're trading, keep in mind of that. Tomorrow is Federal Reserve Day, so it's going to be wild, wild, wild. And then after that, we've got the non-farms. So yeah, next week or two could be some crazy trades. So stay buckled up, right? See you tomorrow. Stay excellent, team.